I would buy bullions, especially numismatics, with abandon, and I would diversify to different jurisdictions because you cannot carry these coins with you onto the plane.
Welcome to another episode of Silver Bullion Television, SBTV. I'm your host, Vincent Lee, filling in for Patrick Vera. We have a great guest for you today. John Lee is the chairman of Silver Elephant Mining. He's a chartered financial analyst, CFA, boasting 25 years in the silver markets, 20 years in mining, and has raised over $120 million for resource companies. Let's talk money, metals, and markets. John, thank you for joining us. How are you today, sir?
Fine. Good morning, and great to be on the show.
Great. First time on SBTV, right?
Yes.
And hopefully not your last. John, you have an interesting perspective. It's a global perspective. Your company's based in Canada. You have roots in Asia. You were educated in the UK, but you also did software engineering in Silicon Valley. Can you tell us a little bit about your background and what you're doing for Silver Elephant?
Yeah, well, Vincent, I grew up in Taiwan. I left Taiwan to avoid the national service when I was 15. And then I went to the UK for A levels and then graduated from Rice University in 95. And I had a brief stint in the Silicon Valley and caught that last wave, the dot-com bubble. And then semi-retired at year 2000. I have over 20 years, Vincent, of experience in the mining and commodity business. I studied under James Turk. And first 10 years as an investor. And so I was studying under James Turk. I was a very good friend of David Morgan. I read every single piece available by Ted Butler and started investing in the metals and in the mining equities from early 2000 to 2010. And since then, from 2010, I I moved down to the mining business and run a junior miner as a hobby. I thought it was kind of interesting to see the other side of the aisle, how it works. And lo and behold, it's 10 years later, double full-time job for now over 12 years running Silver Elephant.
Do you see any similarities in terms of your approach to business in the software world and mining, anything that carried over?
Well, they're a little bit different. I was working in Silicon Valley for a company that was eventually bought up by Oracle. And whereas in mining, we're managing companies a lot smaller. They're junior in nature. And overall, the company of our size right now is around 20 versus thousands of people working for somebody else. And overall, since we mentioned, I've raised over $150 million through the TSX. I've traveled over 35 countries. I actually physically lived in 3 different continents for more than about 10 years each, in South America and in Asia and North America. So I do have that very unique perspective, and I've always sort of been very interested in how the economies work. For example, how can you get away with, I remember back in the year 2000, I was living in a 5-star hotel in Bali for around $20, $30 a day. And how does that really work? And there's also the McDonald's rule where why would you be paying, something around $10, $15 for a Big Mac, but somewhere a lot cheaper in developing countries? So fundamentally, it's really the currency, and that drives the economy. I believe the currency really from the top-down approach. And then from there, really sort of studied under James Turk and got interested in the mining business by accident because I was semi-retired year 2000, and my girlfriend was from Vancouver at the time, and you cannot be living in Vancouver and not be sort of getting yourself into the mining industry.
Yeah, James Turk and Gold Money, that's my old stomping grounds. I was there for a brief period in 2011 as a researcher, so we've sort of crossed paths in that sense. Yeah. We love comeback stories, and I've seen you mention that your portfolio took a big hit in 2008. Not sure how bad that was, but what did you learn, and how'd you make it back?
Listen, that was the 2009 financial crisis. It seemed like over either by accident, but more likely by design, that every 10 years you hit one of those strides. Starting with the 1998 financial crisis, I don't know if you remember, where a lot of the constructions and Asian markets really caught up. What they said, right? When the Fed catches a cough, and then the whole world shaken upside down. And then 2009 was the second episode. That was the financial crisis that was caused by the mortgage bubble in the United States, and that was pretty gigantic proportion. And never imagined that 2019 you got another episode in the native COVID, and that actually sort of even bigger than in magnitude, which led me believe that probably we're going to have another one around 2029, and that will make 2019, 2020 episode seem benign. It was a very big hit. I don't know if you remember, Vincent, I was very heavily into the mining equities, and you have some of the huge, largest mining company went down 90% plus. Techcominco went to single digit, and you had a bailout from the Chinese. And then you have some of my names like Quadra, for example. Some of the well-established copper and gold producers are down 80-90%, and the junior market was completely wiped out. And so that was a big lesson. What's the lesson learned, Vincent, is can't put all the eggs in one basket. So from 2009, I shifted a lot of some of my excess in earnings into the or profits into the real estate business. So I own quite a bit of real estate all around the world. And in the last 10 years, this is done very well, on average in Asia, in North America, and elsewhere, it's done, average 200 to 300% in the last 10 years. So I think the lesson learned is that. And secondly, I would just say that invest in something that's of your core competency and something you can actually understand. And then, I've got into a number of investment decisions, especially in the mining industry, that were tied to politics or legal aspects of mining claims. And so you're betting politics, and you're betting legal court cases, and those are not areas you really want to get into. So I think in terms of mining, you want to make sure you know what you want to make sure what you're getting into, meaning that the commodity metals business is already volatile enough to try to time the metals up and down. You don't want to add additional layers of additional parameters of which you have no control over, or you're not expertise of. In the mining business, when you're investing in mining, you really want to just get the leverage or proxy to the underlying commodity.
I did a little research, and I saw you made some great calls, one of which was in October 2022. You called the bottom on silver at 1750 and gold at 1700. Can you walk our viewers through your thought process?
Yeah, I mean, Vincent, that's also in addition to the call in 2000, and I think it was 2017 when I called the silver bottom at 15, and in October, silver was 16 and a half, and I went on the show in October and said the silver is bottom at 17, and then I called the target for silver for 2023 at 30, and now silver is already 25. So the rally is a lot stronger than I anticipated, so I probably have to revise my call on silver to $50 for 2023. And the logic behind calling silver at the bottom in October was really, again, driven by the what I believe was the top in the U.S. dollar index. When in March of 2022, I got on an interview when the 10-year was less than 2%. I said 10-year would be 3% by the end of 2022. Lo and behold, 10-year went to 4%. So that was a double. So I thought that there's really a lot higher rooms for the interest rates to go up, even though some of the power that be by design want to eject the rates, in fact, a lot higher. If you look at the trajectories of which the 10-year and the Fed's interest rates gone up, it's unprecedented. Probably outside of the 1980 era. So I think there's some folks out there who want to have a little bit higher interest rates. But I think they're getting a very stronger pushback from, you have the pension funds like CalPERS, and you have a lot of people that still have a say in the politics, and they're getting involved and being very active in even Elon Musk is talking about the Fed as being too excessive in its trajectories, and say the world is going to enter a recession. And then at the same time, you're also looking at sort of the oil was trending down from 150 down to below 100. And equity markets are showing a lot of stress. So I thought that the bulk of the interest rate was behind us in around October, and that in turn dictate that the top for U.S. dollar at around almost 115 was in place. and which was largely driven by the rising interest rate, because the fundamentals of the dollar is no better than fundamentals of anything else that's fiat, as I mentioned in the Monaco 64. So if you believe that the dollar was on its leg in this current rally, then the silver and gold, which has great fundamentals in inflation, and then also the wave of the first wave of investors getting into gold and silver. Anybody want to sell gold and silver for the interest rate differential is already gone. So I make that call, and subsequently I said the dollar, I also mentioned in the show, will be trading around 100 to 110 to 100, and that's where we are right now. Gold, US dollar is at 100, which means that a lot of that gain is already being bagged. Vincent, and silver has gone up from 17 to what today, 25, so kind of 40%, and gold has come from 1620, now it's at 1900, 1940. So gold has gone up 20%, and dollar is down more than 10%. I think a bit of counter rally is probably in place. The dollar is probably going to get a bit of a relief, and gold and silver is probably going to consolidate a bit, but you never know. As you know, Vincent, gold and silver are very, very heavily managed, as I have repeatedly mentioned, and provided quite a bit of evidentiary support for that thesis.
Yeah, let's talk Silver 101. You mentioned it's managed. I've heard you mention that the biggest driver, or the bigger driver for silver price, is not necessarily industrial demand, but it's speculative demand. I think you refer to the speculative buyers as price makers, while the industrial buyers are price takers. Can you explain that comparison?
Right. Well, Vincent, it's almost akin to the tail that wagged the dog. Even though in the case of silver, you have industrial demand that account for 70% of the total consumption for silver, whereas the investment demand is at 30%. But it's always that speculative demand that drives the market. Recall in 2021, I think what drove silver from 25 to 50, which took less than 3 months to get there. It was Eric Sprott and reportedly some of the Asian investors that went into the market and asked for delivery of something around 50 million ounces of silver. That just broke the silver market. That just shows you how the acute situation is. 50 million ounces is not even 5% of around the annual silver production. So if somebody went in and with something around 50 million is something around less than $1 billion in cash, can drive such a impact on the silver price. I think goes in with all markets, not just commodities. If you look at real estate, it's never really the people that are. It's never really sort of. If you look at in Asia, especially or Singapore, the average income is probably taking you 20, 30 years of an average person's income to buy a condo. So it's never that demand, fundamental demand, that drives the market. And you can cite a lot of other cases in that aspect as well. And if you look at it in terms of investment and speculative demand, you have a daily COMEX that's trading around 250 million ounces a day, and 50,000 contracts a day. That 5,000 ounces nominal. So that's 250. That's a quarter of the annual production. And then you have the ETF. People, whether the double count or triple count, besides the matter, whether there's actually fundamental metals behind it, regardless, but you have again around 20, 30 million ounces of nominal values of these collection of ETFs that's trading on a daily basis, and that will be over 200 trading days a year. That's around 4 billion ounces of silver. I mean, that's like 400% of the total demand in silver, and so you have all this number and paper that's shuffling around. And it's all speculative. I mean, you're not going to see, very rare do you have an industrial user that say, hey, I'm going to buy ETF and get delivery. Seldom does it happen. It does happen in the case in 2018 when under the palladium, when there's a palladium shortage because of the episode with the Volkswagen scandal where so there's a shift in Europe of the platinum catalyst into palladium, away from the diesel engines into more gasoline engines. And then on the episode, you did have episode where people were industrial users were going into the palladium ETF and they were draining the palladium. supply, but it's not the case for silver right now. So, I mean, largely it's every day, you have 80%, 90% of the silver that are trading just purely speculative. And that's the same speak for oil. That's another perfect example. The oil demand always oscillates plus or minus 5% of the true supply. But yet you have oil contracts trading at, 20, 30 times the nominal underlying demand or volume consumption for oil. And that's why you see the episode where oil went to -5 back in the financial crisis. So I don't think silver is alone in that regard. And all these markets for all aspects of the bond market, the currency market, the equity market, all the price discovery process is long gone.
Yeah, speaking of those premiums on silver, you recently made a comment that typically when the premiums are so high relative to the price of silver, it usually it signals the end of a bull cycle. But we haven't, well, first of all, do you believe we are in a bull market for silver? And the second question is, compared to other asset classes, we haven't seen the same sort of run. How do you make sense of that in silver?
Silver and gold, Vincent, they're money. They're real money. And the monetary system was hijacked in 1913 or 1910 by the creation of the Fed. And Edwin Griffin is wrote in an excellent book called The Creatures of Jekyll Island. You can talk about, I believe that today, like my daughter is going to school and they're just being fed by a lot of things are just on purpose, just try to not so much brainwash you, but they're stuffing you with so much every day. My daughter's 12. But like from 8 o'clock in the morning to 4 in the afternoon, she's inundated, right? Being just stuffed with stuff. So you've been long taught about the Fed as being independent, but nobody really talked about why the Fed was created. There was talking about to modulate financial volatilities, but we have. It seems to me that the episodes are getting bigger and wider and greater in magnitude in these crises. And then the Fed has been printing ever since. If you look at the price of the stamp, less than 2 cents, and now I don't even know what it is today, 60, 70 cents. The only way to keep that, and it is that fiat system that drive the modern systems and then drive everything that's happening today. All the different agendas, because without the printing press, you cannot sort of dictate the terms of your programs, and now recently, if you look at all the crazy deficits, maybe 10, 15 years ago, I'm probably a generation ahead of you, but people actually had some physical disciplines and watching out for budget deficits and every election you're talking about, you do have a good wholesome debate about reining in deficits and have a balanced budget. But now, people are like from Donald Trump is like, if you're going to run a deficit, run it bigger and better. And then people are just throwing money at all different causes, from the climate change to war, to what's happening in Ukraine, to COVID, to vax, to everything. And all of that's fueled by fiats. And the only way to keep that moving, to keep the system moving, is to make sure that the real money, gold and silver, is suppressed. And I think there's a lot of talk about, and there's plenty evidence to support that. There is, as I mentioned, Vincent, the futures market that help put a lid on the silver prices through a very heavy future management. There's also the ETF, of which absorbs additional demand. People thought that they're buying physicals through the ETF when they're really not. And there's a lot of penalty for fund managers to be buying physical metals, like the RSPs and IRAs. And I'm not sure in Asia, in Singapore, maybe they have restrictions. And if you go to the bank and buy bullions, they give you a passport, gold and silver passports instead of the real goods. And so there's just a lot of, and then there's also the advent of the digital currencies, the cryptocurrencies. I think that's another vehicle to siphon the demand away from gold and silver. So you have all those different things that are driving, that sort of putting lid on gold and silver. And not to mention, I watch this futures market quite closely and monitor that. And it is my belief that the way it works, Vincent, is when there's a drive into the metals business, even the headlines or somebody getting to it, they will let the market go for as high as it could until, and they will even fuel the sort of the power that be would even fuel that drive to try to create that top of the market. And from there, they're going to start chipping away in the futures and ETFs in all different ways. They'll even throw some physical supplies in the market to try to host down the market. And then they will chip that away. And that's why you see all the incredible volatilities in gold and silver. I mean, gold went from, 2,000 in 2022 to 1,600. Silver went from 30 to 16. And now silver is back from 16 to 25. And just go to speak, I don't think there's, a tremendous difference in demand that's driving all these volatilities. So it's really a lot of price management and taking away the price discovery. So even though and it goes back to saying, Vincent, even though I believe that there's going to be a little bit breather, consolidate for gold and silver right now at the 1950 and the $24, $23 level, it doesn't mean that because the rubber band is being sort of hung so tight that any particular event or anybody come out of the woodworks or try to stage a run on the gold and silver, it can easily sort of break out of this consolidation range, in which case the big resistance level for silver will be around $28 range, and for gold will be around 2,100. And once those two levels are passed, nobody really knows what's going to happen after. And see, given sort of the pace of the rallies in January, gold is riding 1950 and silver at 25. I do believe that in 2023 you're going to see a breakout of the gold past 2,100 and then silver past 30, in which silver could be catching up to $50 very, very quickly. So Vincent, to answer your question is, first, it has to be managed to keep their agenda moving. And secondly, we haven't even seen the best of days for gold and silver yet.
Yeah, I can't stop thinking about your book recommendation, The Creature from Jekyll Hyde. Yeah, maybe they should make that required reading in schools. Have you started your daughter on that yet?
Well, instead what you read is these macroeconomics, right? And then it's just all bunch. I think microeconomics are interesting, but I do have a degree in economics. But macroeconomics are just a bunch of things. A lot of that just being sort of spoon feed into sort of the thinkings of the generation of the money managers.
Great. To wrap up your outlook on silver in 2023, can you repeat those price targets again and maybe expand upon that before we move on to questions about silver elephant mining?
Yeah, Vincent. I also read a lot of newsletters back in the days, like Aiden Sisters. So Aiden, one of the two. I do believe that technical analysis married with fundamentals is the best way to guide your future forecast. So right now, silver is trading at a consolidation range. I would just say between $20 to $28. I think the days of under $20 is behind us. And then you're going to see gold right now trading at around 1850 to around 2100. So it's at upper band of the consolidation range. I do believe it's going to break out this year. The biggest reason is it's probably going to decouple from the dollar index sometime this year, meaning that the dollar index might still trading at 100 to 110, but the gold is going to break out. I just want to briefly mention politics. The biggest reason, as I said, also in the Monaco 64, is the dollar standards is broken down. Everybody used the dollar system as a matter of convenience. The Saudis were buying the dollars and selling oil because the United States was the biggest weapon producer and the biggest purchaser of oil. And now China can make weapons. It's just as good as the United States, but not as good, but it's good enough. And then Chinese and Asians are the largest oil purchaser of Saudi. And then if you look at again, Putin got this $350 billion confiscated, and you have China and U.S. going at war economically with a lot of different sanctions. So Saudis doesn't like the U.S. brown nosing then into what Saudis are doing in Middle East, and China is not very friendly to the United States. And then you have all the talk about China attacking Taiwan. If that happen and U.S. stood still, which I believe would be the case because there would be such strong pushback in the U.S. for them to interfere in the Taiwan business, then Japan is going to have second thought about keeping that $600 billion US reserve. So you have, all in all, well over $2 trillion of US dollars has been already divested. In the process, the renminbi is up 10% in just the last couple of weeks. So you're going to see that diversifying the dollar holding away. And where are they going to go? I mean, listen, they're going to go to euro, and where are you going to go? Singapore dollars, and there's only one game in town. That's why there are some people speculating that something around 60 to 70% of the physical gold purchases are from anonymous sources, and it's going to be all this national. It's not the national government that are buying right now. I think it's a lot of wealthy individuals and politicians that are getting into gold before the inevitable happens, which is the diversification of all these national reserves all around the world, away from gold, away from the dollar into gold. And that is going to be the principal reason. And when that does happen and people catch the light on, and you have all the fund managers that see the light bulbs went on, and you're just going to see that ferocious demand into physical metals in gold and silver, and that is going to really drive gold and silver. I just want to mention one more thing, Vincent, is that because of there's a lot of interfere in people's dailies, and also the talks about the central bank digital currency, they're not shying away from it at all. The white papers from the Fed is already published, and the public consultation process has already started. I was in Vancouver briefly. There's a lot of shops out there that literally do not accept cash, Vincent. It's going to happen. It's happening. It will happen, the CBDC. And what that means, Vincent, is that then you'll be dictated on how you spend your money, where you spend your money, and when you can spend your money. If there's a curfew, then your digital currency is not gonna work. And they're not going to let you buy a orange juice in Costco 100 miles away when you can buy it next door from where you are. And when you consume too much carbon credits from flying or eating too much cow or beef, they're going to say it's time to get some tofu. So, and a lot of people are not going to put up with that. And the only way you can get away from that is to resort back to the real money, which is gold and silver. And that's why for the first time in 10 years, I've started buying silver bullions again. I highly recommend people that follow me, get with the coins. The premium is going to go higher. And they're throttling. They're not going to say that, hey, look, we're going to ban gold and silver's money. But instead, they're throttling the demand for silver through the limited supply to retail, to the mints. And you're going to see every year, you're going to see the mints running out of gold and silver in January and February of the year. And you're going to see the premium going up and up. Like, for example, when silver is $18 an ounce, as you know, silver premiums was 30-40% in the physicals. And these are unheard of. And it's going to go higher. It's going to go higher. And so my call on gold and silver is $50 for silver this year, and gold past 2,100. Well, just said 30 past gold, silver past 30, and gold past 2,100. From there, gold can easily go to 2,500, and silver can go as $50. And that is my call this year. I think September is going to be that rally is really the ones to watch out for right now, Vincent.
Yeah, American Silver Eagle premiums reached 120% about end of December. That's incredible.
These numismatics I have a lot, hundreds of them. These numismatics are going to be the place to be. You're gonna make out very well, and the day just come. When the inevitable day comes, and you're just going to be taken out of these coins to the shops to exchange for your digital currencies, and you might ask your grandma to do it, or you might ask your relative to do it, and then trade that way. But those days, I think this day is going to come before I hang the hats, and more likely before 2030, as part of this overall all nothing and be happy agenda that is taking place.
A lot of our viewers are first-time buyers, or they're ramping up their purchases. What would you recommend to those looking to buy, let's say, 100,000 in terms of strategy? What indicators to look out for, like the gold-silver ratio, type of storage potentially? Any guidance there?
Well, Vincent, historically, the average gold and silver ratio is around 70. So right now, I haven't been doing a lot of trading lately because I'm running Silver Elephant full time, and I've closed all my futures position because I think a lot of the first leg of the big rally is already behind us. So at 1920 versus 24, So the ratio is at around 70-80. So indicated we haven't really seen the top. And right now, silver is bottom, and gold at 1920 is quite a ways to go. I wouldn't try those indicators too much. As I mentioned to you, I mean, I was shell shocked of what happened in the last couple of years in just crazy world. I don't want to get too much into it, but what I would recommend is if you're well preserving, try to establish as many residences as you can, and then diversify your bullions in different storage facilities around the world, because you never know what happens. Like I was in Asia, I was in Canada, and they had COVID, and they had lockdown. I said, okay, well, Taiwan did not have lockdown, so I moved my family. And then a year later, Taiwan had total lockdown. So you never know what each country is. And it seems that these programs are repeat, right? Rolling basis as they're prepared. It's almost like a drama, like a serial drama episodes. They're just repeating one after another. And I think 2029 is going to be another big episode. I have some idea of what I think will be coming. And it's got to do with the, you got to be careful because, right now, everything's so heavily reliant on electricity, from the EVs to the digital currencies to everything, banking, transacting, even real estate, taxes, payments. Can you imagine a world without electricity for a week? And that may be what's going to go on around 2029. And I think that's going to come. And you just want to make sure you have some wealth that's stored safely that you can actually use to transact, and just imagine how you can plan your life around a world without electricity for a couple of weeks. And then on the other side of the aisle, when the switch does get turned on, it's going to be havoc and it's going to be crazy, and that will create a golden opportunity and for you to deploy your wealth. So I would say, right now, I would just buy silver coins with abandon and without abandon, and then diversify from as many places as you can. Be comfortable. Like I have residences in Asia, in North America, in South America. I can get on a flight on the next day, and I could be very comfortable with my office all set up. Right now, I'm in Mongolia, and that was something I recommend. I would stay away from real estate anymore. I'm not buying anymore, but in the unlevered real estate business, real estate like South America, they've gone up around 30-40% in the last 2-3 months. So I do think that I don't believe that the equity is going to correct very heavily right now. I think they're reflating. Everything is over 200-day moving average. So I think the debt bomb is largely over, and now people are deploying their capital, and we are reflating right now. So I think the episode is going to continue, and which again builds out a very strong case for gold and silver. So right now, to answer your question, I would buy bullions, especially numismatics, with abandon, and I would diversify to different jurisdictions, because you cannot carry these coins with you onto the plane, and you just want to make sure you'll be able to be mobile, you can be able to move quickly, comfortably, and then that you have these coins in different places, Vincent. That is my very strong recommendation.
Yeah, to wind down, let's talk silver elephant mining. It's listed on the TSE, the Toronto Stock Exchange. You're the CEO. Can you tell us more about what you guys are doing right now?
Yeah, I've been mining silver elephant for 10 years. I'm very fond of silver, as you can tell. I've studied the silver industry for 10 years, and I really acquired silver. I really sort of got into mining business as a hobby. I know more about mining than I ever want to know in terms of politics, in exploration, in all aspects of it. Its flagship project is the Pulacayo silver project in Bolivia, a country I lived there for about 4 years, and it has about 100 million ounces of silver in the ground, over $50 million spent on it. I do think that, Vincent, it is is listed on the TSX under ELEF, and then under the OTC is SILEF. I do believe that it is a good time to get into mining. From the XAU ratio over silver right now is like the likes of First Majesticks are trading still half of what it was only a year ago, even though the silver market is bottom. That's another good indicator right now, Vincent. Even though silver and gold are staging a fierce, unequivocal comeback, a lot of the mining companies are still trading at 20% from the bottom. So now's a good time to get in the mining business and looking for, especially you want to look for either a producer without much debt or a junior mining company with proven resources in the ground. And these equities are, I think equities are better in many ways than keeping than other financial instruments. This is semi-fiat assets. But given the power that they are also heavily vested into equities, like the BlackRocks and Fidelities and likes, they probably owns around 30 to 40% of all the equities around the world in the S&Ps. So they're not going to sort of temper with your equity ownership per se, which means that a diversified holding of mining equities is a good complement in addition to the bullions that you own.
Great. Well, that's John Lee from Silver Elephant Mining. We'll be publishing some of their links to their websites in the description. And John, I want to say thank you for being on Silver Bullion Television today, SBTV.
Vincent, thanks a lot. We covered all the grounds. Hopefully it's useful for your audience. And I look forward to being on your show. Maybe sometime in 6 months from now. Let's see where the gold and silver is.
Sounds good. We'll see if the call is correct. All right, John, we'll welcome you back. Take care.
Thank you.
That was John Lee sharing his views on the economy and gold and silver. To follow more of John's work, check out his website at silverelef.com. Silver Elephant Mining Corp is trading on the Toronto Stock Exchange under ticker ELEF, as well as on the OTCQX under ticker SILEF. Like this video, smash that share button, and subscribe. We greatly appreciate your support, and audio-only versions of this interview can be found on iTunes and Spotify.